This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dogs, D-A-W-G-S, spelled D-A-W-G-S. Find our podcast and subscribe. Well, we have a guest today I'm really stoked to have on. He is certainly no stranger to the Old Dogs REI Network. He has been on three previous shows. First one starting in 2017, another in 2018, and then one in 2019. So it's been a few years since we spoke, and I'm really excited to have him on. I'm talking about Hunter Thompson. And Hunter is a full-time real estate investor and founder of Asym Capital. Since founding Asym, Hunter has helped more than 400 retail investors acquire over $150 million of mobile home parks, self-storage, retail, office, ATM machines, and cryptocurrency assets. Man, he is in all these areas here. Hunter is also the host of the popular Cash Flow Connections Real Estate podcast, which has received over 1 million downloads. He also wrote Raising Capital for Real Estate, which hit #1 on Amazon in real estate sales and selling. And I might add that that book in particular, we always ask our guests what their favorite real estate investing book is, and it's starting to come up more and more often. So I am really stoked to welcome back Hunter Thompson. How you doing, brother?
Hey, really appreciate the introduction and looking forward to the conversation.
Oh, well, me too. And he's a neighbor too, a little bit south of me here, actually north of me here in Orange County. He's in LA area. But yeah, I'd like to just kind of catch up. It's been a few years. Tell me what you've been up to.
Well, a lot has gone on. We've experienced some pretty significant growth in our company, and though we have experienced growth, our investment thesis has remained the same. We have a very boring investment thesis that does change in terms of percentages of allocation, but generally speaking, just the slow and steady recession-resistant assets. Now, to your point, we did recently, offer a Bitcoin mining fund, and I think there's an interesting play there. It's uncorrelated to the overall economy, but mobile home parks, self-storage, and multifamily apartments still are 70 to 90% of what we do on an annual basis.
Yeah, in fact, back in 2017, you were talking about investing in self-storage when it wasn't even cool, And now, everybody's going crazy for self-storage.
That's true. I'll actually just add just a piece of that because you're right. at least in the online space, that was something that we were a little bit ahead of the curve of. But if you want to look up a chart, if you're not familiar with me already, I'll say probably the most proud chart of my career. Green Street Advisors did a study of NOI growth across all the popular commercial real estate assets. And you're one of the few people that, I mean, I was focused on mobile home parks and self-storage since around 2012 or so. And those two asset classes just absolutely crushed everyone else in terms of NOI growth. Now, that doesn't paint the whole picture, of course. The cap rate compression is another piece of this, and multifamily was a massive benefactor of that. But NOI growth is very predictable, and so that will paint a picture of how we view the space. We're looking for predictable cash flow based on supply and demand, and we think that those three asset classes still to this day are, it's weird to say undervalued just given what's taken place in cap rates, but I'm going to make the case today that we've got room. And if you think it's competitive now, and if you think cap rates are low now, just wait. So we'll talk about all that data point, but so there you go.
Well, you also had, like the rest of us here, had the opportunity to deal with COVID and the results of COVID and what impact that might have had on those investment areas, which I know at the time when we were talking that you were saying these are, pretty much inflation-proof type investments. And how did they fare, during that difficult time period?
Let's talk about the past, and we can also talk about going forward, because this is a really important topic for right now. But I mean, inflation in real estate, I think a lot of people think that real estate is a hedge against inflation, which would kind of imply that it's a wash. And it's just not the case. Inflation is a massive benefit and to real estate owners of particular asset classes. So multifamily apartments for sure, but even more so mobile home parks and especially self-storage. Both mobile home parks and self-storage are repriced on a monthly basis, as opposed to multifamily apartments, which is typically every 12 months. And let's say office, which can be 5 years. So from an inflation standpoint, just from a repricing standpoint, self-storage and mobile home parks are extremely desirable. But can I add a little bit more detail there? Because I think that that's something that a lot of people already know. And there's levels to this inflation discussion, which is so imperative right now.
Sure. Yeah. Bring it on.
So there's basically, as far as real estate's concerned, there's two types of inflation, and there's three segments of inflation that make inflation really, really compelling. So the first is asset price inflation, which is where as the money supply increases, asset prices, the multiple on which these assets are traded increases. So the value increases even if the NOI does not increase. And I think that a lot of people see that intuitively. They look at the stock market. I'm sure you've seen the chart that compares the money supply with the stock market, especially since 2008. It goes up and to the right with a lot of correlation. But that is not the only reason that inflation is a benefit to real estate owners. The other piece of this is what takes place at NOI, net operating income. And this is especially true of assets that have very low operating expense ratios like self-storage. So I think a lot of us make the mistake of thinking that if inflation impacts everything in our business equally, that it's basically a wash, which would make sense without looking at the numbers. So if inflation is taking place in your market at, let's say, 8% per year, then you would anticipate that rental growth would increase by about 8% per year. And if you're being conservative, you would also anticipate that expenses would increase at about 8% per year. And so that can sound like there wouldn't really be any impact to the net operating income. And so no one's really in a position to complain or have a celebration, because it's like it's up, it's down, it's all kind of a 1-to-1 ratio. But especially in self-storage or even B-class, C-class multifamily apartments, it is not a 1-to-1 ratio between expenses and income. So usually most operating expense ratios in self-storage are like 35%. Multifamily apartments, 80s build properties, 38, 42%. And so what that means is that if rents are going up by 8% and expenses are going up by 8%, because there's far more rental growth than there is expense growth on a proportional basis, the net actually increases significantly, so much so that the higher the rate of inflation, the more net operating income you create. Does that make sense?
Mm-hmm. Yeah, that's true. That's true. Good point.
But then there's this extra piece that almost no one talks about, which is the purchasing power of the borrowed money that you've borrowed to purchase these assets. And this is where this story gets really compelling and why we can tie it into the conversation around interest rates. So when we buy a $15 million piece of property, we put down $5 million or so. We buy a $15 million property, we get a $10 million loan. In today's dollars, that $10 million is obviously $10 million. But what inflation does to the borrowed dollars is it erodes the purchasing power to the rate of inflation, meaning that if we do see 8% inflation for 10 years or even 7 or 8 years, the purchasing power of that $10 million is cut in half over that time period, meaning that I still have to pay them the $10 million back, but the value of that $10 million is cut to today's dollars of $5 million. This is insanely beneficial to real estate owners who have borrowed money at relatively inexpensive rates. And we can talk about what that means, but that is a crazy, crazy, holy cow moment. And when you combine all of them, asset price inflation, consumer price inflation, meaning rental growth, and also the destruction of the purchasing power of the borrowed money that you will pay the bank back, you have the trifecta of awesome opportunity as a real estate entrepreneur.
Yeah, and I think if you add to that the value of the asset compared to what you paid for it in dollars from years past, I mean, you've got this huge gain. It seems that the benefit would, when you look at the equity side, would just be outstanding. Exactly
right. That's exactly right. And so these things need to be taken into account when we're thinking about what happens when inflation takes place, and especially when there's political pressure. The central banks tend to raise interest rates. And so right now, there's a lot of discussion around what that means. And I actually just interviewed 22 experts on this topic. I have a summit that's coming up about this exact topic: rising interest rates, inverted yield curves, and recessions, and what they mean for real estate entrepreneurs. And I was able to interview people in different niches, and they gave me some really good insights in terms of like what this means. By the way, you can learn more about that summit at 100k2invest.com. It's a free summit. It's going to kick butt. But what I want to talk to you about is that when interest rates rise, that impacts deals. Like, that's not some like indicator of something down the line. It's happening right now. I personally know a $30 million property that was bounced out of escrow because the interest rates rise during the escrow period. But to put it in context, interest rates are still negative on a real inflation-adjusted basis. So compound all of the trifecta that I just mentioned with the fact that you can actually borrow money at negative rates. And so when people talk about what interest rates rising means for cap rates, if you look at the historical data, those two things do not move in lockstep with each other, but they do move much more closely in lockstep with each other on a real inflation-adjusted basis. And right now, rates are negative when adjusting for inflation, meaning that if inflation is at 8% and you can borrow money at 4%, you can get this trifecta not only for free, but for they pay you. This is crazy.
-4%. Yeah. Man. Wow. That's a great point. That's a great point. Are you seeing that rise of interest rates in any projects you're working on right now? I mean, you mentioned that one that fell out of escrow. I didn't know if that was one of yours, but is that something that's impacting any of the deals you're working on?
Yeah, so good question. So just to kind of clarify for those that aren't familiar, so we are I'm a registered representative under FINRA. I raise capital professionally, and so we're one step removed from the specific operations of these various assets. And that's, by the way, why we're able to participate in a diverse group of property types, because we are not niched down like you should be if you are an operator. So I just wanted to provide that. So some people think, how can he possibly know all this stuff? Well, we don't know, quote, all this stuff. We know one thing, which is how to find great deals, or deals that we believe to be great. And so what that means is that different operators are being impacted differently based on their strategy, who is providing the debt, et cetera. But I'll give you an example. I know that, residential rates, for example, increased, 150, 175 basis points when people were anticipating that maybe that they would increase 175 basis points over a 2-year period. Well, the same is not true for the bridge loans that are sourced by debt funds. We've seen about a 50 basis point increase in those types of loans. So our deals have not been as jeopardized as some of the people that might be using different debt vehicles. But do I think that's going to go on forever? Probably not. But I think it's clear that those debt funds that a lot of people are using for multifamily purchases right now are not as deeply impacted by the residential mortgage rates. It's obviously clear.
Yeah, that's something that I'm seeing too a lot. I mean, the Fannie and Freddie days seem like they're on pause here for a lot of investors, because it just doesn't make sense. Whereas I think a lot of the bridge loans and the shorter term vehicles are having. I mean, they're real popular right now, at least from what I'm hearing from other investors and just the projects I know about.
Correct. That's right.
Wow. Well, it's interesting. One, I love the fact that you're diversified, that you are in different areas, even crypto. And did you see during this time period, the 2-year time period here, certain asset classes that did maybe much better and others that didn't perform as well?
Well, obviously retail and office got really challenged during the COVID lockdowns. And then also senior living, of course, has had real serious challenges as well because of the unique impacts of COVID as it relates to the age of the population and such, and the fact that in a senior living community, you're surrounded by people who are of higher risk, generally speaking. Mm-hmm. And so in the asset classes that we've had that have been retail, office, senior living, there's been it's not like multifamily where everything is just, holy cow, just you're printing money basically. We stopped distributions in a senior living property, which, by the way, almost everyone in that industry has done, because you have to pause. And one other thing about the senior living business, the operating expense ratio is actually quite high, going back to that conversation about inflation. However, the demand for the product is so incredible that I think once these short-term problems are resolved, the tailwinds are just massive for that industry. I mean, you've seen the data, what the demographics look like and what's about to happen in that industry. And, we think we're well positioned from a cap rate standpoint, buying assets at 9.5 caps, and which I anticipate, I would not be surprised if that was a sub 6 kind of environment in, let's say, 5 or 10 years, just given that everyone's chasing yield. And this is a really important point. Central banks all over the world printed about $10 trillion just in the last 2 years. So when that happens, there's a tsunami of liquidity searching for yield, or I should say surging through the economic picture. And I think United States real estate is by far and away the most favorable risk-adjusted vehicle in the world. Obviously, that's why we do it. Right. So, but there's this incredible supply and demand imbalance, both of assets to demand, but also in terms of investment vehicles to liquidity. And so when we have these assets, I think I'm very, very bullish despite the recent discussions around, the inversion of the yield curve, interest rates rising, et cetera.
Right. Did you see a boost in any of your asset classes that you didn't anticipate?
Well, yeah, I mean, we have multifamily apartments in Phoenix, and Phoenix just experienced. There was a time where we were going through due diligence, and the market, which is the fifth largest market in the country, experienced 15% year-over-year rental growth as a massive city.
Phoenix is going crazy.
We checked the data again in June, and it was 20%. We checked it again in July. It was 25%. It got up to 33% year-over-year rent growth. Rent growth is supposed to be a non-volatile figure because rent growth is based on sound fundamentals. Like in 2008, when there was these massive new loan products and equity valuations just shot through the roof, rental growth is not supposed to be like that. But when you have hundreds of thousands of people moving to a city, when you lead the country in population growth, job growth, income growth, net worth, you're going to see that. And it's just to see that type of rent growth during 2020 is not something we anticipated. It's certainly not something we underwrote. But these values, the sales are going to speak for themselves. Wow.
What about self-storage? I know that there, the whole shift in, remote, jobs and so forth. Did that impact self-storage or in any way?
Well, I think self-storage is probably the number one asset class of the 2020 experience.
Really?
Because all of the, if you go back and listen to our interviews that we did in 2017, that thesis was proven quite accurately. And I don't want to, if you go back and listen to my interviews, I think I probably make fun of myself quite a bit. And so this interview has been a little bit different because a lot of the things that took place back then, we played out exactly as anticipated. Now, I have mentioned senior living retail. I mean, it's illegal to go to retail centers for some sense. I don't want to give the impression that it's all good, but the point is diversification pays off because I couldn't have predicted that it would be illegal to go to retail, right? But that's one of the reasons why we are positioned in the marketplace like we are, because it's difficult to predict these kind of black swan events. When it comes to self-storage, though, I think that not only did it play out the way we anticipated, the fact that tenants aren't supposed to actually spend much time there was a massive benefactor given the nature of the black swan event, a virus that was communicable between people. There's not supposed to be any people on the asset.
Right.
So there was really no pause. And the things around, recessions and downsizing, they kind of played out as we anticipated as well.
Oh, I mean, just the number of offices that that were vacated and so forth.
Right.
I would imagine this, they would need storage, and people relocating and all the dynamics. I would think self-storage would do really well, but I'm hearing it from the horse's mouth there. So it definitely sounds like you benefited too. That's great.
Exactly.
Wow. Well, you're in these various areas. Sounds like you're doing some great research too. You're talking to economists. Nobody likes to be the Nostradamus here, but what are you hearing? What are you feeling that the future, the short and longer term, have in store for us, especially those that are in this investment space?
Yeah, good question. So before going into that, I want to just provide some context because I said, well, this is kind of weird because I've just been talking about some wins. So I'll definitely talk about a major L I took, which is about interest rates. Mm-hmm. So I have been very vocal that I think that interest rates are going down and to the right for quite some time. And I guess I should say we were in the debate. My partner, Ryan Smith, and I in the debate, Ryan's part of another firm, but in the debate, we were partners making the argument that the trend would continue, and over the last 40 years, people that have been kind of concerned or wondering or investing based on interest rates rising significantly back to what they refer to as historical norms were wrong, and that they were investing incorrectly. It's not just being conservative. If you think that interest rates are going to rise in 2017 and you stop doing deals in multifamily in 2017, you can say you were being conservative, but we doubled investor capital since then. So I don't really know, I don't really know what the right way to address that is. But in that debate, I mentioned that over the next 24 months, and this is the nature of the debate, interest rates would go down from where they were. It's been 12 months. I think it's now very likely that we're going to lose. We won the debate, by the way, but I think it's very likely that we're going to lose the actual fact of what's going to happen. I just want to be transparent about that. But I still believe that interest rates will continue down and to the right over the long term. And I think that people that are concerned about interest rates rising to what they refer to as historical norms or averages is not the right way of thinking about it. I think that the question is far more likely, when are they going to go negative? Right. And I have quite a bit of data to back that up. Basically, the entire world, the industrialized world, has negative interest rates. And the other pieces of the industrialized world are not the global reserve currency. So I just do not see how the U.S. is not going to eventually, over an infinite time horizon, my confidence is 100%. That's not really useful as an investor, but over an infinite time horizon, the United States government and the politicians will eventually push the can so far down the road that they must go negative. And like I mentioned, currently, rates are negative on a real adjusted basis. So I may have been wrong in the debate, and that's fine. But I really do think that's going to continue, and I think cap rates are going to continue as well. Real quick, I saw Kathy Fedke post something about this, and she's someone who I really look up to in this industry as well. And she posted the 100-year interest rate chart, which I look at all the time. And she showed the average as being 7.7. And just looking at that, I just don't see the average being a relevant figure. That's just not the way I read the chart. Mm-hmm. It looks like this massive trend line from 1970s to the 2000s down and to the right. And so if you say what's the average? It's like saying, hey, this is a really good analogy, or at least from my perspective, self-acclaimed good analogy. But if you were to look at the last 10 years of Tesla stock and say the average is $300, it's that's not a relevant figure. Right. That's exactly. Not to show you what you should anticipate things heading towards, right, from my perspective. Mm-hmm.
Yeah, that's a real good point. What are your thoughts on the housing industry right now as a whole? I mean, we're talking about a shortage of product. We're talking about the interest rates obviously changing. We're seeing, I think at this time, one third of home prices actually coming down. What do you see there, and how do you think that will impact us real estate investors?
I think that there's obviously a massive shortage of housing, particularly affordable housing in the United States. I did some research on this topic from another debate that I was in. And depending on who you ask, the United States is short about 3 to 5 million units of housing. And housing has not come back, and development has not come back in that time. So the demand is there. If you look at the data in terms of income, net worth, rental growth, they're all suggesting that they're trending up and to the right. I mean, net worth and income are basically at all-time highs. And then you may see that and say, okay, well then if everyone's leveraged to the moon, then that figure is irrelevant. Like if you borrowed $100 million, your net worth would be really high, but your situation would not be healthy. I don't know about your personal situation. If I personally borrowed $100 million on my personal balance sheet, that would give me a improper look at what I should be doing with my time and money. But the reality is debt service coverage on a household basis is at a 40-year low. So you compound that with a shortage of supply, and I think you're going to see, again, housing prices continue to rise. Now, will they continue to rise at 20% per year? No. No, but if that cools off to 15% or 10% or 8%, historically like close to all-time highs. So the point though is that this is not being driven by some unique ahistoric loan product. It's being driven by the sound fundamentals, the reason we love real estate, supply and demand.
That's interesting. There's so much discussion and debate in this area. You even have people like Neil Bawa that says that the calculations are off because they're estimating a population growth that just isn't happening right now. And it's interesting. In terms of projecting a shortage when in fact it may be a lot less than we think in terms of the needs in the housing. So it's there's a lot of discussion there, but I think that's obviously key to those of us that are especially heavily in the multifamily space in terms of how we're going to be able to continue to generate the kinds of profits we need too. What are you looking at? It's interesting that you've moved into crypto. I don't know if you want to address that a little bit on the mining side. I'd like to get your thoughts on crypto and on other asset classes maybe you aren't in yet that you're maybe considering going into.
Yeah, so the Bitcoin mining space is interesting because first of all, everyone listening to this right now is suffering from some degree of Bitcoin FOMO, right?
Right.
And if you're not, you totally should be, because pretty much everyone would have benefited if they had more, right? So, but there's a lot of reasons that our investor base are kind of averse to investing in those types of products because they don't provide depreciation, they don't provide cash flow, there's no predictability of outcome. And so it's interesting because Bitcoin mining provides an opportunity to get exposure to that space without foregoing significant cash flow or the potential for significant cash flow, depreciation because you're investing in machinery, miners in this case, and some predictability of outcome just because historically speaking, the distributions from miners are not as volatile as the price of Bitcoin. They're related, but they're not. It's not a one-to-one ratio. Right. So we started doing some research on the space and found a sponsor that we're really excited about the relationship, and don't want to go into too much detail about the specifics of any opportunities we have. But if you want to go to our website, you can learn more at asymcapital.com, and it's a very interesting. And by the way, that's not something we typically. It's not the profile of the deal we typically do, but it really resonated with our audience. We have a lot of libertarian investors just because I put out a lot of libertarian sympathetic content. And so, we've raised almost $10 million for that offering, and it's really resonated with our group.
Awesome. That's great. Well, I did have one question, specific to our audience that I wanted to present to you. And one thing that I'm noticing that a lot of folks that are in that retirement space or approaching the retirement space, the people that we target, for this show, have been taking advantage of, the high prices right now of real estate to liquidate and take a much more passive role. Those who are that may own their own assets as opposed to syndicators, and they're kind of in that mode of, okay, this is I'm moving totally into investing in other people's projects now. And I know your book is just excellent in touching on that area and some of the dynamics there. But you have people here that their income is based on rental income for the most part, and it could be in the self-storage mobile home or single family home. They're kind of anxious to kind of replace that income. So there's like a little gap there. You're hunting for the right sponsors and the right operators that would have that you feel comfortable putting your money into. But then there also there's this little gap here. Okay, I'm losing my rental income. I have to replace that, and I live off of this income. Are you finding that that operators are creating more product to be able to give people a more immediate return on. I know there's a lot of funds. Everybody's got funds now, and that wasn't the case when I first started investing. But there's just a lot of funds out there, and more like REITs that are popping up here. Are you seeing products out there that would be more desirable for the person that is just the cash flow investor who is looking, okay, I don't want to have to sit and wait, for the equity play here. I want to be able to, get that cash flow going as soon as possible.
Yeah, I think that's one of the reasons we've done some stuff in the Bitcoin mining space and the ATM business in particular. It's very difficult to get, especially unleveraged, significant cash flow or the potential for significant cash flow in today's environment. And yet it is a really good idea to have some exposure to both equity related assets and also assets that may depreciate, not just from a tax standpoint, but also from a valuation standpoint. So with the ATM business, for example, the return profile is with the understanding that the asset itself will be useless in, let's say, 7 or 8 or 9 years. And so the cash flow is such that it can make up for that to the point where the cash flow is actually higher than the IRR. So you could see a situation where the cash flow, 25% or something like that, and the IRR is 18%. Well, how? Because you're not selling the asset. It's just going to go to zero, but the cash flow is such that it creates the opportunity for you to pay off expenses. You're getting your own money back potentially from a risk-adjusted basis or a risk mitigation basis. And those are really compelling things to add into your portfolio, especially when multifamily apartments are trading at sub-4 caps. Right. And so we do a combination of both at Asym Capital.
Oh, that's great. That's great. Well, you have some interesting events coming up here, and I did want to give you some time to address that and some of the benefits that people might have in attending or participating in these events. Would you mind, kind of addressing that?
Yeah. So first of all, I appreciate the opportunity. So I've been able to work on a lot of things, a lot of cool webinars, podcasts, interviews, live events, online events, etc. But the thing I have coming up is like, oh my gosh, I am so glad the timing is just so perfect to put out something like this. The 100K to Invest Summit is the answers to a lot of people's questions right now. The inflation discussion we're having right now, that is a massive warning to everyone that's concerned and potentially sitting on the sidelines. Like, your capital will be eroded. That discussion around the $10 million the bank has lent you being eroded, do not be on the losing side of that argument. So with that said, though, the economic winds are shifting. There's going to be some winners. There's going to be some losers. And it's important to navigate these waters with a lot of confidence and knowledge. This isn't like a mindset thing. This is, you got to really know what you're doing. And so we put together the 100K to Invest Summit, where I actually interviewed 22 experts in different niches. So mineral rights investing, self-storage, mobile home parks, Bitcoin mining, RV parks, discounted non-performing notes, performing notes, development, low income tax. And I can go on and on. Every single interview is a niche or a strategy. When I think about strategies, I think about things like infinite banking or tax exposure reduction, such like that. Every single interview from a passive investor's standpoint is designed to accomplish one of the 3 buckets of wealth creation, which from my perspective are protect, grow, and multiply. And so each day we talk about one of those buckets. And so at the end of the summit, you'll have a very good understanding as far as my view, some of our experts' views, and you'll have a lot of confidence. So you can learn more about that, like I said, at 100ktoinvest.com. It's a free summit. All you got to do is put your name and email address in. Of course, if you upgrade to the VIP thing, you get like all these extra bonuses and get direct access to some of our speakers. And so it's really cool. I'm excited about it. And you can watch it at your own time, which is the best part.
That's great. And the format is basically, I mean, it's going to be one-on-one interviews, panels. How is that going to be presented? Are they going to be like just like individual seminars or webinars?
Yeah, so it's basically one-on-one interviews that are about one particular topic. So I think, this podcast is a good example. We've talked about a lot of different things. And so you can get a lot out of a podcast interview, but if we had only talked about inflation for like 30 minutes or 40 minutes, like the level of depth and sophistication is usually higher than what most podcast interviewees or listeners want. But the summit is very specific, so that if all you want to learn about is investing in A-class properties late in the cycle, we've got an excellent interview with Dan Hanford, who's purchased almost $1 billion of Class A assets. And so the only thing we talk about, we don't say like, hey, what's going on? Like, how's your recent vacation? What's your new dog's name? Just like straight into the topic. And so you get, 22 interviews with that kind of mindset of each particular niche or strategy.
That's great. That's great. And might add too, we're going to have a link in our show notes to that too. So as you're going over, what you had spoken about already, we're going to have a link there for folks that are interested in signing up. So, or checking it out. So, that's really a great program, and it's definitely timely. There are so many things going on right now that we have to be aware of and prudent in our investing. That I love from what I've heard already that you're going to be covering that very broad span that I think our investors need to know about. So thank you for sharing that.
Happy to do it, man. Appreciate the opportunity.
Wow. Well, this has been great having you on, Hunter. I didn't know if there's any other things that you wanted to address, if you get that we didn't touch on, that you think might be significant for our listeners right now, especially as it pertains to, investing, passive investing today in our economy.
Yeah. So, I'll keep it brief. This is one of those massive wealth adjustment moments in the economic history. Like the $10 trillion bomb that the central bank set off is going to have massive ripple effects of the economy, both in terms of asset price inflation, consumer price inflation, and also the destruction of debt. And so how we play this game over the next 5 years in particular is really, really important. So I want investors to have confidence to make the right investments with the right sponsors, but with a lens through which to view this opportunity, which is an economic lens. Everyone is playing the same game. Some people don't know it, but they're all playing the game of economics. And so I have a really specific focus on it, because if you're really good at what you do and you're not knowledgeable about the economic side of things, you can get wiped out without paying attention to it, and it'll be blindsiding. So the summit that we did, it's through that lens. What makes sense right now? And it doesn't mean that you guys should be investing with me or anyone like that. I just want to give you the view of the potential out there so that you can get money off of the sidelines, because that for sure I know is going to be the massive losers over this next shift, is those who were frozen by analysis paralysis. So I just want to give you guys the confidence. So I appreciate it.
Great. That's great. And I think that, one of the big pluses too of your approach as well as this conference coming up is the diversification aspect, which I think is really key. We don't know if there's going to be a crash. A lot of people say, no, it's impossible. We can't. And other people are saying it's already evident, and so if something hits that hard, you want to know that you're protected in some way, and there may be areas where you do get hurt, but you'll have other areas that maybe will. like you were talking about self-storage, where that just go through the roof. Yep. Because you've balanced your portfolio and you've diversified enough to be able to hedge whatever's going to happen.
Awesome. Thanks a lot for the opportunity, Bill.
Well, it's been my pleasure again, man, having you on. I'm sorry I missed a couple of years there since I started this podcast where we weren't talking, and I'm really glad you came on and for the update and some of the great stuff that you're doing. It's just awesome.
Sounds great.
I also want to thank all our old dog listeners out there for joining us today. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Now, please note everything that Hunter talked about today will be outlined in detail in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog, and you're going to look for the episode with Hunter Thompson. Like we mentioned, there'll also be a link to this event that's coming up in there as well. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.